Chris Toomey, who leads one of the country's most highly rated private wealth advisory teams at Morgan Stanley, describes the stock market as being priced for perfection.
Yeah, I would say almost the whole market is right now. I think everyone got excited about what was happening with earnings, but this was the whole Wall Street game going into the year. Expectations were earnings going down 4%. April 6th, earnings were expected to go down 16%, right? And so if we're down 8%, that looks like a beat, when in reality, the trend still is very negative.
If the negative trend turns out to be less severe than anticipated, then the situation could change completely.
Right, but then you also have to look at what the market's priced for right now, right? So if you look at the price of the market right now, it's over 18 times in a situation where we now officially are going into an earnings recession, and there is a 50-50 chance, depending on which way you look, as to whether or not we're going into an actual economic recession. So in that environment, do you really want to put an 18 times multiple on the market? Probably not. This is because if we are going into an economic recession, you're going to have a problem, right? So, if we remember the story, the beginning of the year, economic data is looking better, inflation's coming down, we have no landing or soft landing, and so equally weighted, the S&P 500 looked really good. Then we had this whole situation where the data started turning, and then the banks really had a problem, and you saw that 2-year crash, right? And then all of a sudden, when rates are crashing, you also get the sense that long duration assets are going to do well. So you had people running into tech, which I could say is that sequential next domino with regards to the market falling out. I don't think the technology industry is immune from the overall economy, right? And I think if you talk about what's being priced into the market right now, what's being priced into the market are 4 rate hikes and 200 basis points of cuts, right? And so I think you've got door number 1 and door number 2, and both are not good options, right? Door number 1, we have those rate cuts. The reason for those rate cuts is that there is clear confirmation with regards to the fact that the economy is really in a recession and we need those rate cuts, right? That's door number 1. Door number 2 is we don't get those rate cuts, the market's pricing them, and the market's going to have to come down and reevaluate the fact that we didn't get that 200 basis points of cuts. And then taking a look at that scenario, you go back to your friend Professor Siegel, who is now demanding that we get those rate cuts. Otherwise, we're going to see a really messy market.
Can you address a common belief that rate cuts are always bullish, even if the economy is not doing well? Some suggest that rate cuts will still be beneficial, but you argue that they will only happen if the situation is dire. Can you explain why rate cuts may not always have a positive effect on the market?
Well, typically, if the yield curve is inverted, the economy is going down, typically that means that we're cutting rates for a very specific reason. We're not in a situation where we're in this economy that's growing rapidly, which is a situation where we actually have to cut rates in order to keep the economy going. This is a situation where we are turning lower, and we need these rate cuts to keep the economy from really going much lower. So in my mind, I think the thing is we need something that's going to preempt those rate cuts, and that preemption is going to be negative for earnings and pull down stock value.
Chris Toomey discussed how the S&P 500 is trading over 18 times multiple despite negative earnings and economic trends. He warns investors that while they may still want to go for quality and play defense, investing in long duration assets like big tech may not be immune to the overall economy. He notes that the market is pricing in 4 rate cuts and 200 basis points on cuts. However, if these rate cuts do not occur, it could lead to a messy market. He believes that there needs to be something that preempts those rate cuts, which could potentially lead to a strong bull market in the future. Despite the market's current state, Toomey believes that there is a 50-50 chance of an economic recession, suggesting that investors play defense and consider quality investments that may better weather a potential economic downturn.